Just a couple more things before we get started. I want to give a shout out and a recognition to StartupSac's sponsors, without whose support we wouldn't be able to do the things that we do. So we want to say thank you to SMUD, Witten Law, Bender Insurance, Nivagen Pharmaceuticals, Stoll Reeves, Weintraub Tobin, Holcomb Law Group, Clifton Larson Allen, Moneta Ventures, and Ernst & Young. And one last thing, I want to do a special shout out and thank you to SMUD, who is our platinum level sponsor.
In 2030, in just 9 years, I'll be 18, off to college,
probably getting my own place.
I want to live where the air is fresh,
where they take care of the planet. I want to live in the best city,
the cleanest city. I want to live in a clean power city.
By 2030, SMUD will be 100% carbon-free, so you can live in a clean power city. Join the charge at cleanpowercity.org.
So thank you, SMUD. We appreciate the support. And if any of our other sponsors are here, we want to thank you as well. And the main part of this event is a discussion on seed stage venture capital from an investor's perspective. A lot of startups want money from investors, but what do investors want from you? Tonight, we're going to explore that tonight with our panel, and I want to, we need to start spotlighting our panel. Maybe Cameron, if you can help me spotlight Mariah, Monique, Ken, and Jim, and we will turn the program over to Mariah, who's going to moderate the panel, and Mariah, maybe you can introduce yourself and have the panel introduce themselves really quickly before, and then get to the actual questions and topics to discuss. Take it away, Mariah.
Hello, thanks for having me back. I'm always excited about having our happy hours, and even though I missed meeting in person, I so appreciate the life and connection that you've brought to the startup community with these online events consistently. So wonderful to be here. I am Mariah Lichtenstern, founding partner of Diversity Ventures. I also launched the Sacramento chapter of the Founder Institute in 2017. We've graduated 2 cohorts. I love to participate in the events going on at the Carlsen Center and the Toolbox series that's starting back up here shortly. So I hope you're subscribed and get the newsletter. So that's just a little bit about me, but we have some amazing speakers here today. So I want to go ahead and pass the mic around to each of you to introduce yourselves. I'm just going to go in the order that I see you on my screen. So if we can start with Jim and then go Monique and Ken.
Hello, everybody. Jim Sperlazza. I'm a chair of due diligence for the Sacramento Angels. I am a entrepreneur since I was 19 with my first company, and I'm still doing it, still love it. And to me, the startup phase is the most exciting, and lots of energy, and I love being here and listening to what you have to say.
Hi, everyone. I'm Monique Brown. I'm the managing director of the Growth Factory, which is a new pre-seed accelerator that's launching in Sacramento in September, alongside an accompanying early stage venture fund. And we're focused on investing in companies from the greater Sacramento, Northern California region that are on a venture backwards path and led by amazing founders. So I'll pass it to Ken.
Hi, everyone. I'm Ken Tallow. I'm a partner at Winning Street Ventures. We invest exclusively into very early stage technology startup companies. I'm also a board member like Jim on the Sacramento Angels, where I've been investing in early stage companies for probably, let's see, it's coming up on a decade, and have always had an entrepreneurial streak. I started my first company in my 20s. It failed miserably, but I learned so much, and I've taken those learnings forward with me, and have been enjoying participating in the early stage investing space, and looking forward to having this discussion and hopefully getting some good questions from everyone in the call.
So you guys heard it, start queuing up your questions, and you can drop them in the chat, and I'll try to keep my eyes peeled for that. So, okay, you all. Unbelievably, it's 2021. We're in what is this? End of Q3, going into Q4 here.
Right.
And we're still in what I've heard called the panini. I call the panoramic at this point. And the first question is really, what changes has been in this virtual world of the panini, the panoramic, brought to early stage venture, and how founders connect and pitch to investors. So I'll just throw it out there to whomever wants to jump in.
I'm happy to start with that, and just share that part of we're also part of something called the Global Accelerator Network, and so we're in conversations with early stage funders and programs around the world, actually. And what we're seeing kind of universally are a couple of things. One is, before the pandemic, there was this really place mattered quite a bit, right? Like there was just this huge capital concentration, obviously, in like the Bay Area, Silicon Valley, New York, Boston, and entrepreneurs who are outside those regions, in regions even like Sacramento, although I would argue that we have proximity, but we're really lacked access, I think, to capital. What I feel like we've heard is that the pandemic has lessened the importance of place and almost, is opening up opportunities and the openness to investors to be exploring opportunities outside of companies that are located, down the street from them. So I feel like it's actually been a good thing for pre-seed, early stage startups who are looking for capital, because there is an increasing acceptance of connecting via Zoom, pitching via Zoom, getting to know people via Zoom, and an acceptance that growing companies outside of kind of the core engines is growing.
And on the angel side, Jim or Ken, would you agree that that's been a silver lining?
Jim, go ahead.
Yeah, I would say I take a couple of things from this. Yes, there's a silver lining there. I think it taught young founders early on the definition of burn rate and reserving capital, how to make the most of what you have, how quickly you can get to proof of concept, because that's when you're going to start entertaining other investors. So I think a discipline that, and I'm not saying it wasn't there before, but I think there's a new discipline because of what we've had to go through. And Mariah, as you're saying, I don't even remember the start date now, but it seems like we've been in this for years. So as Ken pointed out earlier, we have companies that are still alive and well, and they are alive and well because they learned early on they had to tighten their belts. You had to push off to the side things that weren't prioritized, and make sure you're alive to tell the story when we come out of this.
Well, I know I've saved a lot of gas money. What are your thoughts, Ken?
Yeah, we did save a lot of gas money. And I think that's, those are some new behaviors, I think, that are going to ripple through this investment community, right? To Monique's point, angels used to take on a very kind of a community, local community investment strategy, right? If I could see you and meet you and hear a great pitch, I would be interested in investing in you. And that was really one of the mantras of the Sacramento Angels, right? But with COVID, you couldn't meet people face to face, so we opened it up a little bit broader. So it wasn't a showstopper for someone down in LA or out in Utah or even the East Coast to pitch to the Sac Angels. So we got a different flavoring of companies. And I think people really learned throughout COVID is there are technologies out there that allow us to communicate quite well remotely, right? And these technologies have been around for, frankly, a decade, right? And it's just no one knew how to really use them or embrace them. Everyone thought you had to be on a plane and fly somewhere. So I think that was a big plus for the investment community. And also what I've seen over the past year, as we expected, COVID hit, everything kind of shut down, including investment. And people just kind of sat back and wanted to see how the economy was going to play out. And things started to open up again. And I think what has happened is there's now a lot of money on the sidelines. So much so that I've seen behaviors change in the investment communities, not so much with early stage angels, but in the in the food chain higher up with the VCs. You'll hear often, you're raising $1 or $2 million. Well, that's too small for us. We only write checks of 5 or 10 million. And therefore, there's this artificial gap in the industry around funding where, angels and early investors will easily raise 1 or 2 million, but when you say 5, they can't bridge that gap. And the other investing institutions don't want to come down to that level because it's just as easy to write a $5 million check as a $1 million check, but the amount of due diligence is the same, right? No matter what. So those are some of the other things that came out, I think, with COVID that we're all having to kind of realize and digest at the same time and adjust.
There's a question that came up in the chat, and I just want to address it now while we're on the topic. Lisa asked, how can one get access to that surplus in capital? Do you see that as a surplus, or is it really something else going on?
Surplus. I call it a surplus because I think there's more money out there chasing good startups than there are startups available. And I fear that what'll happen ultimately is it'll start getting bidded up, right? And I fear as an investor, right? If I'm an entrepreneur, great, bid up the valuation of my company. Sure, I'll take 5 million versus 2, but sanity will set in, right? The industry will normalize again. And if you can't justify a 5, 10, 15, $20 million valuation, you'll end up paying for it in the long term, right? You won't be able to do your next round. So, caution there, right? Of trying to raise too much money early on. You got to raise just the right amount. And it's a little bit of an art, less of a science on how to do that. But there is money out there. And again, there was probably 9 months where I didn't see a lot of investing going on. Monique, Jim, did you? I mean, last year it seemed kind of quiet.
I agree. I think it slowed down. I think people were very reserved. I think that prudence was the key word, and I think that's why there's a surplus that you guys were just speaking about. Is that people are not throwing money at a dartboard right now. They're being very specific about what they wanted, what level they should be at. The same kind of thing that Ken was saying about venture capitalists that want to see $5 million checks. Well, they also want to see $3 million to $5 million in revenue, or they won't look at you. So, everything is compartmentalized into different levels from seed level on up through, your A round, if you will. So I do think there's been more prudence. I think there's more due diligence. I can tell you that for a fact. There's a much more deep dive, as we call it, into companies before you pull a trigger on an investment.
I'd say a couple of things. So one, where do you get access to that capital, right? It still goes back to, like building your network, right? Like, I think that's still something that remains true. It's just how you're building your network may be different, right? And so even on this call, we had the pleasure of having someone in our breakout room from Monterey, right? Another person from San Jose, right? They're building their network, right? They're reaching out to communities and getting to know new people. And so before, I'm sure neither one of them would have driven up to Sacramento to join this startup happy hour, but now it's much easier for them to dial in from where they're at and get to know new people. 1 Million Cups, we see that all the time. We've had presenters from around the country over these last several months. I think it's amazing. And, and just some of the work that we're doing in the accelerator world, we're seeing accelerators share deal flow across states and countries. So I would just say, get online, find your people, like whatever that is, the industry or areas that you're working in, and just start reaching out. And I think there's a lot of, pitch competitions, accelerator programs, a lot of things out there right now that are looking to support entrepreneurs, and many of them are doing it virtually. So I think that's a good place to start. And then in terms of I just want to echo Ken's point from an investor standpoint on the amount of capital and the valuations right now. that are worrisome, right? We're just seeing like larger seed rounds and higher valuations, right? And it feels like everything is just used to be like you know, that seed round was like under $1 million or something, right? Now what is it, like 2 to 5, right? You know what I mean? It's just like and you know, to Jim's point, like really wanting to have some milestones that funding is connected with, so that you can continue to raise at the right valuations as you move down the pipeline. But with that said, I'll say that nationally, Q1 of this year, I can't remember the Q2 numbers, but they were even higher. Q1 this year, $64 billion in venture capital was invested into companies in this country. It was a record-breaking quarter, and Q2 was higher than Q1. And so there is a lot of money out there. But I think maybe pent-up demand or something from the initial COVID shutdowns when it did pull back for a bit.
Now that we've kind of dipped into where these, you know, these seed rounds are coming in these days, it's always fascinating to me to watch the trends. And I try not to like wade in and feel like FOMO around hyped up valuations or, you know, things of that nature, but you know, they still occur, and it is what it is. So when a company is coming to you and they say they're raising a seed round, and you're seeing, you know, these asks, what do you expect to see? And I think, Jim, you raised this point. What do you expect to see to back up these valuations and the ask?
Yeah, let me see if I'll comment. So, you know, when looking at companies, my assessments have actually changed over the years, right? Several years ago, if I saw a tech company, I would dive into the technology and see just how good it was. And then I would look at the market opportunity and the team and all these other factors. Now I've kind of flipped it. I just go, okay, so what is the market opportunity? You have something, tell me what it is. I'll just assume it works for a moment. What's the market opportunity? There are a lot of really good businesses out there, right, that you can start. But the question is, can they really scale? So if you can create a business that generates $500,000, $1 million a year, great, go start that business. That's a wonderful lifestyle, right? But if you can't scale it to hundreds of millions or billions or whatever the magical number is, then you're not going to get a lot of investors to go on this journey with you, right? Because angel investors and VCs, they're looking for these hundreds of millions, billions of dollar type companies. So then looking at the market opportunity is really kind of first and foremost. Is there a big enough opportunity that makes me interested? Next would be honestly the team, right? Is the team, do they have the experience? Can they execute? It's not so much about the revenue that they're producing in early stage, right? Because the revenue will come, hopefully, if all is executed well and the team has the experience. And then, of course, since we invest in technology companies, then we dive into the technology, right? Is it viable, right? Have you claimed to create cold fusion? Well, prove it, right? Show me. So the order of diligence questioning has kind of changed. So really, honestly, we can get to a quick no, because most cases it's no, and find those few that are, that's interesting. That could be a potential yes. And then, of course, we dive into due diligence, which, of course, Jim leads for the Sacramento Angels and can tell you it's not an easy process. But as he said earlier, we dive a lot deeper than we had in the past. And I think, and that's a good thing. I think the bar's been raised on due diligence with not only the Sacramento Angels, but all investors, I think, across the board. Monique, you agree or?
I fully agree with what you just said. We are taking a similar approach, right? For us, because we're at the earliest stages of funding, like our customer is the next investor, right? Like, so if we can't, if we can't identify and support companies that we feel can get invested further up the food chain, then we're not doing, right by our LPs, right? Like, and so we have to be looking at companies that we believe can scale. And we see a lot of great founders with, you know, a solid business plan, right? Like in a solid business, but to your point, they're not venture backable necessarily. Like, and that doesn't mean that you shouldn't go start that business, right? It just means that we're not the right funder for that business. I want to make that really clear, because we are not the only like type of capital. There's other, you know, ways that you can perhaps, you know, look at financing those efforts. But, and then the other thing I would say is along with your comments on team, because I agree with that as well. It's early stage, right? We don't have a lot of data on, you know, performance, right? Like, especially with us, you know, your pre-revenue, maybe you've just completed an MVP or some early tests, so that customer engagement is maybe not high yet, right? But you know, it's like we're looking at that bias toward action, and how are you solving problems, and, you know, how are you synthesizing the information that's coming in from other people, right? Like, and so in your, you know, we've come across, and maybe you guys have too, right? Like founders who think like, all I need is money, and then, right? Like, and yes, capital is a critical component to growing a business, but it's, you know, it's like what, and if you, and what, you know, what are you going to do if not, right? Like, kind of thing, or what are the next milestones? Like, with funding it's this, and without funding it's that, right? Like, but I want to see those teams that are constantly thinking about, like, how do I advance the ball to that next milestone? And that kind of thinking gives me a lot of confidence that this person's going to work to figure it out, even when they're in resource constrained environments.
So I want to go over to Jim here for a second. I know Ken mentioned this already, but Jim, because you do lead due diligence, there's a question in the chat around profit and loss, or P&L, and whether it's a scientific wild-ass guess, and how angels make the leap of faith. And so I think that's a great time to dip into the question of the kind of diligence you do when you're evaluating companies, and determining just how wild those pro formas are. So thoughts there, Jim, and on what founders should expect in going into diligence.
Well, you know, when you get past the, you know, we're only going to look at a pro forma, you know, and those are best guesses. I want to know that the founders have, you know, done their homework, as Ken pointed out, and they understand what the market opportunity is. They defined it. They know who has it. I mean, startups are one of two things, right? They either disrupt a current industry, or they begin a new industry. Basically, those are the two things that happen. If you're disrupting, then you have a lot of competition. Do you understand it? I want to know who they are. Are some of them potential strategic partners? Because that's something that a founder should also look at as well, as early as possible. Where can I find a strategic partner that, one, may invest in me, but also may provide an exit for me down the road? The finances, how are you going to spend the investor's money, market opportunity, team, the experience. And I think both Monique and Ken brought this up. I'm just going to add to it, coachability. When we look at a team, I want to know that you're coachable. I'm not going to sit here and pound on your head, or you know, I'm not the gift here of the entrepreneur world, but I want to know that you'll listen. I want to know that you'll take heed to what your advisors are telling you. I want to make sure that you know how to pivot when necessary. I think we've seen this year with our COVID restraints. I know Ken specifically has a couple of companies that, because they were able to exercise restraint, they're still here with the ability to still scale and succeed. You can't succeed if you're not here. So diving into those kinds of things, when you're looking at early stage, there's not much else you can look at. You can define the market opportunity pretty well. It's not that hard to do anymore. You can look at the team. What kind of experience do they have? Have they gotten a group of a group of advisors? Have they tapped people that they know have a great deal of experience in the industry they're going to attack and brought them into the team? I know if we're looking at an early stage presentation deck, one of the things I want to see is who are your advisors? Did they invest in your company? Do they believe in you? Those are really, really points that go well beyond just giving me a P&L that you just kind of put together, because let's be frank, that's all it can be, is a put together P&L. Sure, you can identify what your expenses are going to be and what you think your revenue is going to be, but there's always hiccups. So you need to be able to pivot. And that's what I want to know. I'm not going to pound on you if you miss a deadline or if you miss a milestone. What I want to know is that you recognize that you missed that milestone, and what are you going to do about it?
That's it. Those are some excellent tips. And are there things that you would advise founders to do to prepare for that diligence process? And I'm thinking, what do you want to see in the deal room?
Well, I think really simply is what problem are you solving? Is it a problem that needs to be solved? And how are you solving it? Number one. I mean, that's the beginning of everything. Have you picked something that needs to be corrected? Can it be improved? Or like I said, is it something that doesn't exist and you're going to create? Different aspects take different amounts of money, different amounts of investment. If you're looking at an industry that exists and you're going to do better, well, you're going to get more strategic partners. You may not need as much money to get to a scale point. If you're starting an entirely new industry, you're going to have deep pockets, because it could take you 10 years. We're looking at companies today that are starting to be successful. They're 12 years old, and none of us heard of them 10 years ago. They just happen to be out here now. So they've survived, they've struggled, they believed in what they had, and now they're starting to come, things are starting to come to fruition. So, you need to be determined, but at the same token, you need to, have an awareness that other people can help you succeed. And again, it's that coachability part that I look for, most of the time.
So I want to briefly go back to something that Monique mentioned and kind of tie that in to what you've just said, Jim, and can I invite you to chime in on this too? Because Jim, you made me think of one of our local founders that came out of Fourth Wave Female Founder Accelerator, Janine over at M-Train, and she bootstrapped for like 10 years, employment attorney over in Silicon Valley with big tech companies. And, there were just certain barriers for her. She got into Fourth Wave, built out the team, and, came out of it raising 10 million on a, 40 million valuation. Monique, you mentioned like a bias towards action, a bias towards speed. Do you think that in this environment where we have these inflated valuations, et cetera, that there's a little more leniency to looking at companies differently? I know we've had a lot of, awakenings around, George Floyd and, the bias and diversity and just, different barriers to entry for different founders. So what other things have happened during, COVID-19 that have impacted how you approach or evaluate early stage companies, whether they're new or, have been around for 12 years, like this company that you mentioned, Jim, or like M-Train?
Yeah, it's a good point. And I want to maybe clarify, because I think you're absolutely right. And Jim also makes this point, right, is some things just take a while to figure out, right? And so when I say bias toward action, I don't equate that to, can you grow a company in 4 months kind of thing. So and I think that Ken and Jim both spoke to this. There's maybe I should combine that with the quality of persistence, right? Like the never give up, right? And we see that in a lot of our greatest founders. And, it's like you hear about it all the time, right? Like the 10-year overnight success, right? It's like they're plugging away, they're figuring it out, they're grinding, they're pivoting, they're, doing, going out of business, nearly going out of business 3 or 4 times, right? And then all of that, what is all of that? All of that is learning, right? And that learning is critical to building great founders, right? Like those founders are learning along the way, the best, right? The ones that are internalizing that as learning and then applying that learning to what's next. And that's the bias toward action. It's not sitting back and being like, well, shoot, somebody come give me some money so I can build this thing, right? Like they're figuring it out. And, again, not to say that capital isn't absolutely critical in many of these, it is critical in these ventures. So I'm not trying to say that you shouldn't worry about capital or that you don't need capital to build a company. I'm just saying that there's this mindset around, I'm going to figure this out. I'm open to learning. I want to, I am coachable, right? Like I'm going to take the struggles, the obstacles, the failures. I'm going to keep trying because I care about this, right? And I think that's the other thing. And I think that goes to the problem we're solving. If you're working on a problem that you're really passionate about or a problem we're solving, that persistence combined with that bias to action and figuring it out is a great combination for me. And that's a lot of what we're looking for. But I don't mean that to be like, you have to do it in 4 months at all. So if that was the impression, I want to scratch up from the record because that's not what I meant.
Duly noted, Monique, though I have heard in Silicon Valley, and we are fortunately not Silicon Valley here in Sacramento, but where folks do look at the lengthened market as an indicator of certain things. For me, I certainly think it's an indicator of network. Any other thoughts before we jump into this question on valuation?
Valuation's a big topic, so why don't we just jump in?
Okay, so the question is around startup valuation. Now we know it's very different from public companies with PE ratios and all of the things. I'm actually going to throw a link into the chat on some different types of valuations. But can one of you just speak to how valuations on a company that really has no value, no revenue, hardly any KPIs? How do we navigate that in these early stage startups?
You guys want me to take a pass at this?
Go for it, Ken.
Yeah, sure. So there's I'll kind of walk through some stages, right? So there's some stages that every startup will go through. And that first stage typically is called friends and family, right? And that is the round where you go to your friends and you go to your family and you say, hey, with a little bit of money, little being tens or hundreds of thousands, I can go test some theories, business ideas or assumptions, and build out that market opportunity that we've all referenced, right? And potentially prototype a product, right? Or build out a service. I mean, there's only 2 things in the world you can do. You either have a product or a service, right? So you build or prototype that out. And that's what you'll use, friends and family money. And what's your valuation? Well, you'll probably raise hundreds of thousands, so you don't want to give away the whole company. So my company is more than 100,000. Let me set that valuation somewhat arbitrarily at $1 million, couple million. Therefore, I'm giving around 10% of the company away, right? And you use that money wisely, as Jim said. You stretch it as far as you possibly can. You listen to people who are giving you advice, and you get a little bit further down the road. And now you have something, you have proven something. Don't talk about revenue, don't talk about customers. You might, that would be awesome, but most don't. And they now are going to that first round of angel investors. And angel investors want to hear the story. What problem are you solving? What's the market opportunity? What have you already proven? What can you show me as tangible results? And you have to then show them, right? Your prototype or your minimum viable product. The money you spent from friends and family. And that's really your seed round, right? You're looking for seed capital to push the company forward again. Many companies, most companies now do more than one seed round. They'll do several seed rounds. They'll do seed 1, 2, 3, A, B, C. They even give them unique names, right? That I've seen. But the seed rounds, you'll probably need $500,000, $1 million, maybe even a couple million. Again, if you're going to raise that kind of money, you need a valuation such that you're not giving away 50, 75% of the company. So then do the math. Your valuation's probably 5 million, 10 million. That's where it should be. And as we talked about, valuations are getting kind of jacked up, and seed rounds now, they're starting to ask for 5 million. So what's your valuation? 50? What have you got? No customers, no prototype product, or barely a prototype product. And yet still a lot more to prove. And that's where the tension starts in the whole system. And if you have good advisors, and Jim will remember, we had a pitch just a few months ago in the Sacramento Angels, and sounded like an interesting opportunity. but it was very early and the company was valued at $50 million and they were looking to raise a couple million. And we're like, where did the number 50 came from? And the answer was, well, my advisor told me to set it at 50. And the answer was, you're nowhere near that. But as a investor, angel investor, we negotiate, right? We negotiate on valuations, we negotiate on terms. Am I buying a convertible note or are you giving me equity, right? What are the terms of the note? How much equity am I getting? Is it preferred? And all these other things you can negotiate. Angel, and you watch Shark Tank, they're always negotiating, right? What amount of money they're giving for what percentage of the company. So just be prepared to negotiate. But the valuations typically kind of follow the millions, single digit millions, double digit millions. And then by the time you get to the triple digit millions, you better have customers, you better have revenue, you better have a mature product. And again, that varies. And I've seen unicorns shoot out that have absolutely no customers, no revenue, and a very wonderful story. But a lot of those deflate over time. I mean, there's a number of I would say there's a lot of carnage here over the past few years with companies like WeWorks and Katera and others that were billion-dollar companies, and now they're bankrupt. Way too fast, valuations out of proportion, didn't have the revenue or potential revenue to back it up. And that's what you want to avoid. That's where you want to listen to your advisors. And I always tell really entrepreneurs, pick your advisors wisely, because they will give you bad advice. If you're not getting the right advice, you're going to be in trouble soon. You're not going to be able to justify your existence. You're not going to be able to raise the money. You're not going to be able to make the right connections. Choose your advisors wisely.
Now, Ken, when you're talking about these companies raising millions of dollars without any revenue, that just does not set well. It doesn't set well with me. So I want to throw the next question out there. What kind of revenue do you really want to see on a seed stage company? I mean, at one point that was a prerequisite, especially when we had kind of a pushback from an era of, some very notable tech companies that have IPO'd without, really any profit, and that were, reinvesting back into growth and not really, producing what would traditionally be looked at as the valuations that they were going to market with. It seems like the pendulum has kind of swung again. So, what are the thoughts there? What would you like to see in terms of revenue in a seed stage company or other KPIs?
Monique, Jim?
Yeah, I'll jump in. I mean, I think like for us, we're looking at a lot of pre-seed / seed stage companies. And so we are looking at a lot of companies that are pre-revenue, but that have kind of targets in place. And what we're doing is working with them to like kind of back into what are the steps you need to do to achieve those targets, right? And so I think we're looking at, and it totally depends on the kind of company, right? Like, so, and Jim can probably speak to this because I know he's looked at these through the SAC Angels a couple of times, but like, if you're, in pharma or biotech or something like that, that's a completely different evaluation business model than if you're enterprise SaaS, right? Like, and so there isn't like a one size fits all, right? Like in terms of the level of revenue that you're looking to see, because it really does depend on the type of company in the industry. So again, like for us anyways, going back to Ken's like original points, we're looking at the market opportunity. Is there, an opportunity for the kind of revenue that we need to see ultimately for this to be like a venture backable company that our next investors are going to want to take a look at? And then do we believe the founder can drive this company toward that revenue? And can we work with them to create a plan to kind of achieve that? So that's kind of like what we're looking at on our end.
Yeah, I would just add, taking Monique and Ken together, the industry plays a big role too. If I'm looking at a biotech, a farm or something like that, I know before I even consider the valuation that I'm in for 10, 12 years and longer. So what the valuation in today is only a factor of how much more money am I going to have to see this company raise? How many more rounds are you going to need to scale? And that is very industry specific. You know, as angels, we're looking at, you know, we like that, you know, 3 to 5, 4 to 7 year reign. We don't like 12, 15 years. It's too far out. Too many things can change, and too many other players can get into the party if it's going to take that long. So I think evaluation is, you know, number one, has to be based on what the industry is, how long it's going to take, and how many more rounds are you going to have. Because if you're asking, you know, you can throw out a number. If you're telling me you're worth 10 million and you're pre-rev, I may believe you if I know that you only need one more round to scale. If you're pre-rev and I know you need 4 more rounds to scale, well, then if you tell me you're worth 50 million today, I'm going to walk away, because that means you're talking about $1 billion organization before you have revenue. There has to be some logic, I think, to the thinking. And I think it goes back to the team. I don't want to get off track, but it goes back to the team being realistic in their views, understanding what they're doing, you know, understanding what they're going after. And they need to do their homework. And okay, we're in this industry. These are the valuations in this industry. You know, what are the exit valuations looking like? How much of the company do I want to get, you know, do I want to sell away? And to Ken's point, the early on, founders are really stingy. You know, they hate the idea of giving up big percentages of their company. But that's a foolish way to look, because it really has no value on the front end. The value is all on the back end. You can throw a number out today. It doesn't mean anything. You know, the only thing that's going to change is whether or not you can raise that next round.
Right. Mariah, let me add maybe a different perspective on, does an angel investor in a seed round want to see revenue? And I'm going to say no. If you have it, my first question is, where did it come from? And what commitments have you made? Because everyone needs to realize that if you put a product or service out on the market, whether you sold it to one person or 100 people, you now have to support that. And if it's a great product, that's good, right? But if it's not, it's now a boat anchor around your neck while you're trying to swim along to the next round. So saying you have a product or service and saying you have companies and you're creating revenue at the seed round can actually be a detriment. Frankly, I don't know how many angel investors really expect that. It's a seed round. You just came out of friends and family round. You're now doing seed round. As we all said, market opportunity, the team, the experience, what's the roadmap of where you're planning to go and how are you going to go make all this money, and listening to advisors. So I would say, contrary to some belief, angel investors may not want to see revenue, right? Now, later on, it's a requirement, and don't confuse revenue with profits, right? You generate revenue, profits are anything above all the expenses, but if you're a growth company, you're going to take all of your revenue and all your funding and pump it back into the company. So you're really not going to have any profits. And investors are perfectly okay with that. They want to grow as fast as they can. So again, don't confuse revenue with profits, and don't necessarily think that investors want to see early revenue, because early revenue implies customers, which to me can honestly scare me away if it's not a great product that you can support.
That is a really interesting perspective, and I want to thank you, Ken, for mentioning that, because one of the things that makes me nervous, frankly, is when companies are going out chasing a lot of money and they haven't quite figured out the model yet. And if something goes wrong and it's broken, as one of my friends put it, as a venture capitalist, we push you off the building and see if you can fly. And you've already scaled up operations and gone after a broken model before really figuring out if it works. You are not going to fly, and you're going to end up having to wind down the company, whereas you might have been able to go a little bit slower, try things out, at those earliest stages before you scale up. And so I also want to echo what, Jim said in terms of how the team comes into play. and I know, Ken, you mentioned this too in terms of coaching, and go back to the point that Monique, reiterated around, is that market size there? And, can the team address that market? And it just really sounds like you all are stitching together how these components work cohesively and synergistically in, the holistic evaluation of the company. So with that, there was a question that came back up in the chat again on diligence, and I understand that this makes a lot of founders antsy. So I want to address that and then come back to a really great question that Laura threw in the chat. So first of all, what things in terms of diligence do founders sometimes omit, or do they not have together, or do they need to better clarify?
I would say the key one would be the market opportunity. I think it's a tough thing for a young entrepreneur. On the one hand, you really have to be in love with what you're doing, right? You really have to have, a great deal of depth, and your life is about this, whatever it is you're trying to produce. On the other hand, it can't be blind. Blind love will get you in trouble. So realistic love is important. Dedication is important. Coachability, being able to pivot. But if you're blind to everything, I think you're going to fail, because you're not going to see the forest for the trees. And unfortunately, that it does happen a lot. And just to Ken's point, there's a lot of great, what I call lifestyle companies out there. You can make a good living for your family. It can go on for years. Maybe you can leave it to your children. But it's not an investable thing. It's not a scalable thing. It's either a local or a regional type business that, like I said, will do well for the founders, but it's not an investable business. And sometimes founders don't define or look at the market opportunity as deeply as they should. And if you come to me before you've done that, I'm going to be kind of turned off pretty quickly. You need to know that, because everybody can find that out. I'm not asking for something that's hard to find out. And if you don't have that detail, then I'm probably going to walk.
That's interesting that you say that. Oh, go ahead, Monique. You want to jump in on that?
Oh, I want to plus one that and add to that, which is part of market opportunity in some senses, but the competitive landscape, right? Because that's the other piece that, I hear a lot. Nobody else is doing this, we're the only XYZ, right? Like that kind of stuff. Or, nobody does it as good as we do. And those statements, it takes a lot to make those statements true, right? And so I feel like, I'm always really excited when an entrepreneur comes into to present and they've really done their homework around this and can demonstrate that landscape and where they fit and what, their path to compete in that landscape looks like today, which it will change, but just demonstrating that they've done their homework, like Jim said, is a huge confidence boost as you think about like how you can work with that entrepreneur, because it just, for me, it means that we can have some honest conversations about what this looks like, and then we can really get down to the work of navigating it, right? So, yeah.
I love that you mentioned.
Sorry, I was just going to really echo. I think to Jim and Monique's comment, right? The one thing I've seen, which I find really interesting in a lot of presentations, what are actually potentially really good opportunities to invest, is the lack of a competition slide, right? Because if that's all you showed me, if you just showed me a competition slide, I can immediately go, there are other companies in this space, which implies value. I can go look at how they're valued and how much revenue they make, and just immediately go, okay, this is who you're going to take on. And we can have a very deep conversation about who's the competition and why are you different. And just by talking about the differences, I can get a sense of, your opportunity. So really that one slide is probably the most powerful slide, but yet still people miss it. And again, it's a competition slide. It's just one slide, but you can spend an hour talking about it. So I highly recommend, absolutely don't miss that, because if you do, and someone brings it up and you're scrambling for it and you don't have that beautiful little picture that shows where you are, and I've seen it shown so many different ways, pick the format you want, but it shows that there's a market opportunity. It shows that there's competition. You are going to show on that slide, hopefully, how you're different. That's a great conversation to have.
I just want to underscore that point, that if there's competition and the competition, it validates that there is a market, because so often really, really early stage and, some first time, maybe somewhat naive founders think that saying, oh, we have no competition, we're the only ones out there doing this, is a benefit. And what it sometimes often communicates instead is you haven't done your homework. So going back to what Monique said, one of the most frustrating things to me is when someone says, oh, we're the only ones, we have no competition, and then you go onto Google and pull up 10 companies that the founder seemingly has not looked at. And then you're starting to question, is this team even competent, ready,
That's right.
Realistic, right? So those are all great points. And then going back to, what Jim said and what's been reiterated. So founders, I hope you're listening, around understanding your market, the TAM, total addressable market, SAM, serviceable addressable market, SOM, serviceable obtainable market, how you're going to get in, right? And where you're going to start. And a lot of times, even for me, that's an area that's overlooked. Okay, so another question that's come up in the chat that I think is really important to to bring up. We've talked about a little here, but we have angels in the room, we have VCs in the room. At the seed stage, given that there are individual angels, angel groups, early stage VCs, all investing at that stage, how would you think differently about these three types of investors in terms of how you pitch them and what the relationship is like? And I would even throw in there too, Ken, you brought this up. It's a challenge for many founders that I speak to, is that friends and family round, right? So we really have friends and family, individual angels, angel groups, and VCs. How do you look at those differently? And I know something came up recently with the founder that I talked to, who was told by an angel group that he was being too bold in his market size, where I was like, if you're not trying to shoot it out, if you're not trying to hit it out the park, I don't want to play. So what are your thoughts on that?
How do you, so the question is, how do you pitch to different types of investors? I think the fundamentals, as we've kind of talked about, with your market opportunity and your competition and all that, still plays. It used to be, and Jim, I think you might have heard it as well, right? That several years ago, the big joke was, angel investors, we really don't do any math, right? That's for the VCs, they actually do the math. That's changed a lot, right? It used to be that you could always find angel investors to put money in your company, just because they love the idea, they liked you, whatever, right? That's changed. Angel investors have upped their game. They want to see some more details, but it's really important across that entire spectrum, be it the friends and family, an angel investor, or a VC. You really have a minute, 30 seconds to explain to them what it is you're trying to do, what problem you're trying to solve, and that there's an opportunity here. Otherwise, they're going to be turned off very quickly, and the rest can go sideways, right? But again, everyone wants to hear that there's an opportunity. We're solving a real problem, and if you were to invest, then you could share in the rewards and the future success of the company. I think that's a common theme across all. But again, as I said, sometimes you didn't need a pro forma or a balance sheet to show an angel. Not anymore. They want to see something that you've thought it through. Sure, we're not going to believe that in 3 months you're going to see this hockey stick kind of revenue. Of course not. It could actually discredit you that you're being way too aggressive. But let's have a conversation. Why do you think that way? But I think the message is there's a theme across all. And I think you need to be better prepared when you start talking to angels now than you would have been several years ago. And when you go to the VC level, they're going to want to see a lot more detail. They're going to see a lot more traction. They want to have more details on your product. They may send a technical team in to examine your product or service or they'll bring in some industry experts to assess what you're doing. It'll be a much more rigorous process.
I want to add to that, and also say, like, dovetailing the pitch with the due diligence is it's very dependent upon also the stage, like the level of due diligence that a pre-seed accelerator is doing for a small investment, right? Like, it has to be right sized, you know, both from like our team's time and legal standpoint and for the opportunity at hand, versus someone who's, you know, diligencing a Series A deal and they're putting a couple $1 million into a company that's far further along, right? Like, and so I think, like, both from a pitch standpoint and a diligence standpoint, it's gonna change. Like, the same company today and 5 years from now, it's gonna change over time depending upon where you are in your journey, because you're speaking to, you know, different kind of needs in the room, right? Like, and what you can show and what you should be able to show at each stage. And so, like, a pre-seed pitch is very different than a Series A pitch in terms of what you need to demonstrate in terms of traction and knowledge and stuff like that. You should be, in theory, like, you know, further de-risked at Series A than you were at pre-seed. We know that we're assuming a ton of risk at pre-seed, right? Like, we know that it's really early and pretty much everything in your deck is going to change, right? Like, you know what I mean? And so I think that, you know, but to Ken's point, maybe there's some common threads across that. And, you know, for me, that's always that problem solution fit, right? Like, you know, and the market opportunity, and that goes through all from the pitch standpoint. If I don't care or don't understand who could care about the problem, I'm like done on slide one, right? Like, if that, or whatever, you know, at the front of the pitch, if the problem is not compelling, then I've probably checked out pretty quickly thereafter. So I think that's, you know, maybe common across. And I think there is some obviously personal subjectivity to that as well, because we're all people.
We just had a question. There's a couple of really good questions here, and there's, you know, a personal question that I want to, you know, come back to after we cover the meat of this. But what are thoughts that any of you have on equity crowdfunding in early rounds? Qualified and non-qualified investors, I'm assuming what you mean there, Bob, is accredited versus non-accredited. And I think you're saying Reg CF going up to 5 million and a potential global investor reach. So what are your thoughts on Reg CF, Reg A? I mean, do you care? Is it even on, you know, is it something you're concerned about or you think is beneficial or not? Any thoughts there on crowdfunding, equity crowdfunding?
So I looked at investing in a crowdfunding platform a few months ago, and I think it's an interesting opportunity with Reg CF and them opening up to 5 million for non-accredited investors, which is new. We're going to have to see how this all plays out. I think ultimately what's going to happen, and my fear, is that some unqualified investors are going to go in and place a lot of bets on a lot of companies, and they're unaware of the risk that they're taking, because the stats are out there. 90-something% of all startups fail. And if you're on a, you know, crowdfunding platform as an investor and you're looking at all these beautiful slides and pitches and you really don't know what to look for, and you didn't realize they didn't have a competition slide in the deck, right? And you go, oh, I'm going to put some money into this, you're going to lose it. And I think it's going to potentially leave a stain on the crowdfunding ecosystem that is there. But it's for the businesses, right? For the entrepreneurs, sure, they can go out and try crowdfunding, right? Depends on what they're selling. In some cases, you're selling equity, right? And you can do that either with stock, or you can actually do a convertible note on some of these crowdfunding platforms. But there are the other Kickstarters that we actually commit and sell products, right? Again, as I said earlier, be cautious about getting products out too early if it's not the right product. But there are channels for investment, and you're making promises. But I would recommend, honestly, finding the network of angel investors that are local to your community or those online. Find those advisors who can give you good guidance and leverage that. Don't just, yes, all companies need money, but if it's a good idea, you're going to find angel investors and friends and family who are going to support you. And I think that is much more valuable than crowdfunding. That's just my personal opinion. But yet I've looked at crowdfunding platforms and I've seen some very interesting companies there. But again, it's a matter of sorting through them all and trying to pick winners if you're an investor. And as an entrepreneur, sometimes you can get lost in the crowd because, there's a lot of companies now going to these platforms. I fear more for the investors. They're the typical person doesn't know how to pick startup companies. Let me be honest, most angels and VCs don't know how to pick startup companies because 90% of them fail. But I think it's like basically telling everyone, take your 401k and now you can go bet it on Vegas, right? And I think that's ultimately what's going to stain and harm the industry.
I think you're absolutely correct, Ken. I sometimes equate it to almost like pump and dump, with the various Reddit sites and, other sites where people are just pumping up a stock and then they're dumping it, and who gets left losing all their money? That person that thought they could jump in a crowdfunding thing. So they're getting more sophisticated. I think there are platforms out there now that are really, they're very specific in what company they'll take on versus some of the crowdfunding was anybody could just do it. Sign up, pay your fee, whatever it is, and you can be on there. Now, I think you have to have a lot more detail. There's a whole cadre of things that you have to accomplish before a legitimate crowdfunding platform will take you on. So I think you're going to have a consolidation of the crowdfunding platforms as we go on, just like anything else. But clearly the investor is the one that's going to get hurt with those kinds of things.
I'll jump in and say, I think it's an instrument that could be really useful in the future. I think right now, I like the access to capital, and I like the access to investment that it provides, right? So I think that's a plus. And I think that I would say that for those companies that fail, it's not just the investors that are losing, it's the founder too, right? And so what I would say is that what we see, and Ken spoke to this, is, and that's why I was saying earlier, it's not just money that makes a great company, right? It's money plus, the smart investment, right? It's money plus support, money plus resources, money plus experience, money plus, advisors, mentors, customers, friends, And so the thing about equity crowdfunding that I think needs to get better isn't the who's writing the check and picking the companies necessarily, because I think that it will get smarter in terms of determining who is legitimate enough to be listed on the platform, right? That there's some diligence that you can do to say, well, this is a real opportunity and that kind of thing. But from the founder's standpoint, who's accompanying that check? And you've got all these people in the, that you don't know and don't see and don't have relationships with. So you have capital, but you still maybe don't have access to network who can support and mentor and advise. And that's a problem that's not solved with equity crowdfunding, right? And so how do we provide this increased access to capital and access to investment opportunity and help more businesses succeed so that the investors also succeed through those platforms? And for me, that's about the people that are getting involved with those businesses. And I don't know how to marry that. I don't know that there's a platform that's marrying those two things well yet, but so that's, I don't know if that answers the question or not.
Well, I think what you all have done very importantly that gets to the heart of the questions that came up is you've addressed, the founder side, and then there's also the investor side, I will say to the accredited versus non-accredited question, Bob, if you Google my tech funding equity project, I wax poetic about that, and I won't reiterate all of that here. But in terms, there was something that came up here. I think Caitlin was chiming in as well about the friends and family. And so from my POV, crowdfunding is not an alternative to the friends and family round for founders. Most of the founders who get on crowdfunding platforms have to reach certain benchmarks. They have to report to the SEC. They have to make disclosures, et cetera, et cetera. Where I do see, it being comparable to friends and family is if you are a non-accredited investor and you don't have someone within your network that's launching startups that you have access to, crowdfunding platforms allow you to get into the private market, but it's not like you know and can trust these founders necessarily, right? It's crowdsourced, so it's imperfect, but we're assuming that that's discretionary investment income that's at risk there, and we would hope that folks getting on those platforms know the risk. I have opinions on that, but from a founder's perspective, I think where the crowdfunding platforms come in is what some of the panelists have mentioned before: is your company even VC backable? Do you have a market to sustain that? What I see on a lot of these crowdfunding platforms are like CPG companies. They may be more lifestyle companies that are tapping into an investment pool, because they're not VC backable companies. And I think that's part of the stereotype. So another question came up is, do you look down on companies that have raised from crowdfunding? I wouldn't say, unless you've had to disclose or report something that, puts you at a competitive disadvantage, that crowdfunding is necessarily a negative indicator. It just goes back to what the panelists have mentioned before, is now that you've raised that crowdfunding round, do you have a market, and can you leverage that capital to grow into the market and be VC backable? That's how I would look at it. So I hope that we've addressed, there was several questions that came up on that. If we missed something there, please do bump it back up. There's something here that I want to make sure that we cover before we go all into questions, and I see more coming in, and that's great. Keep them coming. But why is it important to stay in communication with investors? Now, this is a stickler for me, and I would love to hear you all opine about why it's so important for founders to remain in communication.
Sorry, with investors that have already invested in the company, is that where we're starting?
It's put out there broadly, and I would put it out there like this: staying in communication, even on updates before an investor has invested. If they've not said no, if an investor has not said no, if they've said, put me on updates, you're too early or something of that nature, but they've not said no, you're not in our wheelhouse. And then after the check is written, what are your expectations of communication there? So I'll put both sides out there, Monique.
Okay, great. I'm a huge fan of communication, but I want to emphasize the opt-in, right? Like, so if an investor is opted in to receive communication from you, then there's some great templates out there. Visible is a company that, if you go, they provide a platform for investor updates, but they also have good blogs on the kinds of content that you should include in your investor updates. Is a really good resource. And there's some really great templates. We have a number of founders in the greater Sacramento region that are absolutely stellar at this. And what it does is it helps you gain a very rapidly, quick window into how their company is doing. And to oftentimes, if you haven't already invested, and you've opted into the communication, you're probably tracking it, right? Like, and so looking at that as an opportunity that you may invest in the future, right? But if not you personally, oftentimes with those emails, trigger for me is, how can I help? Oh, I should introduce so and so to this person, right? Like, so by staying communication front of mind, top of mind, before someone has invested, you're presumably communicating with people who care. And a lot of us, anyways, in the Sacramento region are involved in this ecosystem as investors or company builders or community builders because we care, right? Like, and so it gives us the opportunity to be a resource for that founder. After you've been invested in, I think it is you've just taken their money. It's absolutely critical that you stay in communication with them. Like, that's my view. Like, you know what I mean? It's just like, look, you know, this person has written you a check, and in that said, you know, I believe in you and I want to see you succeed, right? Like, keeping them in the loop about the good, the bad, and the ugly. And there's great templates for how to do this in a concise and productive way, again, allows them to jump in and help you succeed when you hit obstacles or when you see an opportunity, right? Your investors in many ways are your very best partners, right? And if they don't know what's going on, they can't help. If we can't talk about the problem, we can't fix it, right? You know what I mean? And so it's like, I think a lot of times communication gets put on the back burner because people are busy, but this is the work of the work, right? Like, and two, because maybe they don't want to scare investors or tell them, or not, not share the oops or the hiccups or the trips, because they don't want to be seen as someone who might fail. And I would just say, don't do that. You know, your investors are in the boat with you now. They wrote that check, and they want you to succeed too, right? And so for me, investor communications is critical, and I won't call them out on this call, but there's like, I can think of 3 that I just adore. They do it fantastically well in this region. So
yeah, I think Monique, you summed it up well. The only thing I would add for me personally is a quarterly update would be great. Every 6 months, minimal. If I don't hear something within 6 months, I start to panic and go, what's wrong, right? Because there's usually something wrong. Yes, they're busy, but one starts to worry that I'm not getting information back. There's got to be a problem. And I think Monique hit it right on the head, which is your investors are heavily motivated by their investment to try to help out. And the better companies that I've seen send out that list of here's our accomplishments, but very big and bold print. Here's what we need help with. And you'll be surprised at who comes out from the woodwork and says, oh, you need a contact at this company or in this industry, or you don't know how to do, 3-factor authentication. Well, just so happens my brother-in-law is an expert. However it works, you can just get that information through your investors. And it's a huge pool, it's a huge resource. Utilize it to your advantage.
I would just add, again, to what both Monique and Ken said, if picking your investors, your early investors, I think is just as important as picking your team. And I like my early investors to be advisors. One, because I did my homework and I found great people that understand what I'm trying to do. They are leaders in the industry already. They're either from a university, accelerator, wherever you can find them. Because one, you're getting a good quality resource, right? Number two, if they see what you're trying to accomplish and believe it and invest in it, that's a big deal. So now you have an investor that understands your market opportunity and also is willing to put money up as well. So now you go to your next investor, you have a story to tell. We have an advisor team that is also, heavily invested in the organization. I think that goes a long way towards getting that next round of investors. So to me, it's like friends and family, yes, first, and then advisors next, and investment from there, and then you can go out from there. And that just rounds out your team early. I think that, as Ken pointed out, I like to see a quarterly update, but I also don't want to see all the highs. I want to see the lows. I want to know the needs. Do you need a person? Do you need an outside advisor? Do you need a contractor? Your investors know these things. They can be very, very helpful. They can save you money and a lot of time.
Well, I hope that founders are really listening to those salient points that you've stated on this topic and have even reiterated, and how important it is to send those communications. And I also just want to throw out there, for venture capitalists, we're expected to report quarterly. And if we have to chase down founders to get the data to report, we are not going to be very happy with you. We're probably not going to want to follow on, probably not going to want to tell our friends in subsequent, who invest in subsequent rounds to invest in you. So that communication really is key. And I want to highlight what both Monique and Jim just said, that, don't just focus on the highlights and the wins. When you are able to activate your advisors and your investors to say, this is what we need, that creates another layer of trust that you're not, committing a fraud. And we're in the midst of, the Theranos founder going to trial at this point. So, are you being honest? Can I trust you to tell me when something is wrong, that you're not going to leave me 3 weeks before you run out of runway and the mess has hit the fan and we can't even rally the troops to help you? All of that is important, but then also that you're conscious and mature and cognizant enough to know what your needs are and to draw on resources to build your company and optimize your company. So thank you for that. Now, Jim, you mentioned, the friends and family and the advisors, and this has come up a couple of times. There's a question in the chat, and this is one that I resonate with deeply because I do a lot of work on DEI and equitable access, and the fact that some of the data that's come up is that 15% of Americans approximately, and that may be an overestimate, are accredited investors. Of that 15%, less than 2% are Black, less than 3% are Hispanic, 70% of Americans don't have access to $1,000 for an emergency. So the vast majority of would-be entrepreneurs technically don't have access to accredited friends and family, which means that, being in a startup, if you're going to, scale and run a tech company, that friends and family round has been a huge barrier to entry. So the question, with that said, and I know I loaded the question, and it may have been something that you haven't chewed on, so I'm kind of waxing poetic a little bit to let you think about it a little bit. Because then even in the roles that I play as an advisor with Skydeck and other orgs, a lot of people who are privileged to operate within these spheres just simply were not aware that access to friends and family was not a given because it's just not part of their lived experience. So the question that came up from Karen is, how does an investor feel about startups without friends and family and making an initial investment there? I'll just say, on my end, I don't care if you got friends and family because I understand the issue. I do want to see what have you committed, whether that's sweat equity, whether that's bootstrapping, taking out your 401k. I know not everyone gets a 401k, but what are you putting into it? Even if that means that you've slogged 5 years, working full time and putting, what would be your retirement money into a startup. I want to see something that shows me that you're committed and you have some kind of skin in the game, quote unquote. So that's me personally, but I'll open it up to the panelists as well.
That is a loaded question. My parents are first generation in this country. I didn't have friends and family when I first started. I had family, I had friends, but none of them had any money. And they could have loved my ideas, but they weren't going to be able to help. I think as investors, we need to be colorblind. We need to look at the opportunity, period. I don't care who brings it to me. If it's valid, if it's something that I think is investable, then I'm going to invest. If someone comes to me that, like me, didn't have a friends and family to go to, I'm still going to listen. We can skip friends and family, and not everybody has. That's a term, frankly, the friends and, where the friends and family term came from, I think, and Mariah, you know this probably better than anybody, is friends and family got in at the last minute on some great opportunities on initial public offerings. If you were a friend or a family member of a startup or had a broker that could help you out, you could get shares before the public did, right? At the opening price, rather than, $100 higher or $500 higher later. So that's how friends and family came about. And then you started adding on, friends and family can be investors in my startup as well. So we're not all even. We work as hard as we can. Some of us have to work harder. With 2 Z's in your last name, like me, nobody looked at me when I was young and trying to do things. It was like, who are you from? It's determination. And if I have to be more determined, if you put another roadblock in front of me, I'm just going to be more determined. If my family can't help, I'm going to go to your family. If their family can't help, I'm going to go to the next one. I think it comes down to determination. And like I said, I don't care where you come from. That's not a factor to me. Your determination, your belief in what you have come up with as a product or a service, that's what's important.
I'll jump in. Thanks, Jim, for your response. I'll jump in and say, yeah, we don't need there to be a friends and family before we look at something. So again, we're looking at market opportunity, team, and how can we help, right? Like those are the things we're looking at. We're not looking at friends and family, but it does beg the question, where do you get that really early stage capital? And I just would love for you to share, Mariah, a little bit about maybe even the conversation that we had on Thursday with regards to how that landscape is beginning to change and where there may be new opportunities. And I do think there is an increase in programs as well that's come with small checks, but some early funding. And those are beginning to proliferate as well. And so I think maybe you might even be able to share some resources that you're starting to see come online and some of the stuff that we were talking about on Thursday.
I'll just echo, there's not a prerequisite for friends and family. I've personally made investments in companies that the founder had a brilliant idea. We vetted it and got a couple other investors to throw some money in, and $75,000 later, 6 months, and now we're raising millions, and there's a multi-million-dollar exit, a few years later. It's not a prerequisite to do friends and family. If you have access, great. If you don't, there are other means. I think you commented, Mariah, about 401k. Please don't tap into your 401k before you talk to some people and vet the idea. I unfortunately have some sad stories to tell about people who have done that, and I would have said, don't do that. No, the idea is not that great. And again, to Jim's earlier comment at the very beginning of this panel, don't fall in love with your idea until you really have vetted it with some people.
Now, I have told the founder to tap into the 401k for a bridge round rather than to dilute when they knew that money was coming. But this is a company that has sales. This is an experienced founder. So, but if you're just really, really taking a risk and you're putting your retirement at risk, I mean, you got to know that's risk.
Right. Well, I saw a early entrepreneur take money out of their 401k. They set up a payroll system and then paid themselves. So on top of taking the money out of their 401k and paying a 10% penalty, they also did a payroll system so that 40 cents of every dollar went to the federal government and state. And I was like, why did you pay yourself? You could have just taken money out of your 401k. Didn't think about it.
Speak with your tax, your advisors.
That's right. Talk to an advisor. Talk to an accountant, right? But yes, I mean, I've seen people, again, we've talked about it early on, right? Entrepreneurs and founders are very passionate about their business, their idea, and that's an amazing thing, and it really pushes you through these first formative years, and it's very challenging and difficult and hard work, and when things aren't going well, thank God for that passion, but don't get blinded by it, because it can ruin your life. It truly can. But following it through, the right advice, the right guidance, the right funding, and you're living the American dream.
Awesome. Okay, so I just want to share, and I'll direct this primarily to Jim, that there's some DMs coming in, anonymous, but especially on the top subject of being an immigrant and not having friends and family of means, that it really resonates. And so you all heard it here. We are Sac Town. We are not Silicon Valley. I know that I've heard for years and years and years so much about the friends and family round. And if you don't have that, or if you don't get an introduction through someone that's a CEO of a portfolio company, then you're not worth it, blah, 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 blah. That's not what we're hearing here. So you can hold folks to it, but do all the things that you've heard the panelists say to do in terms of knowing your market, knowing your competition, presenting your problem and solution, et cetera. Be prepared, to make that risk worthwhile if you don't have people who know you and trust you and have put their capital at risk, because they believe that you're someone who's going to win. Because if someone is looking at you when you don't have friends and family, they have to do that work, and that's a lot of work and a lot of risk to take really, really early on. Okay, so kind of bringing it back to the subject at hand, I know that Juan had a question, and I'm going to try to scroll back up here to find, and he wants to know, how much equity should founders expect investors to take or to ask for in a seed stage round? What percentage of your company are you diluting in a seed stage round?
I wish there was a straight answer. I work on the rules of 15 to 20%, but keep in mind, as I think I said earlier, there's not one seed round. There can be multiple seed rounds, right? And the one thing you want to be able to do is, for every, let's just bookend it, every 100,000 you get in seed funding, you want to be able to leverage that as best you can to increase the value of your company. So if you're going to be valued at $1 million and you're going to raise 100,000, okay, you just sold off 10% of your company. Use that money, develop the product and the service, de-risk it. I think, as Monique said earlier, de-risk the investment such that now I need another 100,000, but I'm no longer worth $1 million. I'm worth $2 million. So now I'm raising another 100 million on 2 million. You slowly increase the value of the company while you bring in these hundreds or 500s of thousands of dollars throughout the seed stage, so that you don't dilute yourself down. It's not like you go on day one and say, I need $500,000 and I'm only worth $1 million. That's 50% of your company. You can get $500,000 over time, and in increments of smaller increments of 500,000 to get to where you need to be. That's what I always advise founders is, it's like going to the bank, right? I need a loan for my next 3 houses. No, you only live in one house right now. Get a loan for one house. So go do it to your investors. And I need enough money to get to this next stage of product development, of market, reassurance or market traction. And then with that money, go and ask for another one. So again, my rule was 20 to 15%. Okay, maybe it'll be 10%, but would I give away 50%? There's scenarios where you could, if you're in a really high growth rate and your valuation is accelerating so fast, sure, go ask for 40% or sell 40% of your company. But those are more the exception than the rule.
I think it's important to realize not only, okay, how much are you? 10, 15%. I'm with Ken. I'm a 10 to 15% person on yearly. And what's even more important, frankly, is what your cap table is going to look like. If you're giving away, 40, 50, 60% of your company in your early stage, you're not going to get a VC to come in later on because you've already given the company away. So you really need to be looking down the road as well at what you're doing here. So to Ken's point, take enough money to make that next milestone and know what that next milestone is. That's going to make your company worth twice as much as it was before the last investment. And that has to be a roadmap. Investing needs to be a roadmap for a founder. You need to know what you need to accomplish before you go out the next time. They always say, make sure you ask for enough. Well, that's true, because if you have to go out prematurely for more and you didn't complete the milestones, you could be dead in the water, and you could have a good opportunity that never gets to fruition because your cap table got messed up. So I think you have to be really prudent about how you do things.
I would love to hear Ken and Jim talk also, just bringing up cap tables. When we're talking about this, when you have co-founders who have ownership, right? Like, and how does that get split, and when does that get split, right? But we've been talking as if there's like a solo founder in some ways in this conversation. But one of the things that we see is those conversations between founders and ownership between founding teams is often not had early enough or documented early enough, and before you go out and start talking to investors. And those can become very awkward situations and actually incredibly painful situations if not well done. And I think probably both of you have had more experience than I do in dealing with founders in situations like that, but I think that would be really helpful for the founders on this call to hear about.
Yeah, I will comment that some of my most worrisome times of investments is when we get issues with co-founders. People need to realize that if you have a co-founder, be it 2 people or 3 or 4 or 5, there will be a point of time in that company's evolution where the co-founders don't agree. And now there's a problem. How's the voting rights? Who has authority over the other? Or maybe one of the co-founders wants to exit, and they can't because they really can't figure out how to exit, right? One of the co-founders is saying the company is now worth more than the other one who wants to get bought out, and it is frankly a divorce. And it's the ugliest thing that you can go through, not only as a co-founder, but if your investors are going to have to go through this, take the time up front to iron out this co-founder relationship. If it's 50-50, then either you both agree or you flip a coin. Or on odd numbered years, one person votes, outrules the other on the even numbered years. However you want to do it, just don't make it 50-50. It doesn't work. It will create a problem. So think that through. It will totally bring down a very good company. And I've seen it happen. And unfortunately, as a early advisor and investor in these companies, I've had to negotiate across both of the co-founders. And in one case, it didn't work. And in the other case, we finally got them to make up and realize that there's no way to separate you two co-founders, without destroying the company. So it's almost, honestly, to me now, it's one of those first few questions I ask when I see co-founders, right? How is this structured? Who owns what? Who's got authority? If this thing unravels, if they don't have that, we put that in place immediately. It's much easier with a single founder when it comes to some of the decision-making and ownership questions. Jim?
I think what it leads to, recognizing early on, is governance. Governance. Forget, sure, you can have co-founders and there should never be 2 of anything, right, Ken? But by having an outside board with, voting rights, sure, the co-founders can be on the board, but you're always going to have an odd number. If you start, you may only have 3 board members, right? 2 co-founders and an outsider. But you're never going to have the problem that Ken just mentioned. You're not going to, have to flip a coin, or is this an even or an odd year, or, today's a yellow day, whatever the case may be. When you come to us, I think for money, I want to see that you've thought things out and that you've got a board, and that board is ideally part of your advisory team as well. So I think you avoid the problem by doing that early, and it also shows me that you've done your homework.
I'm so glad that Monique brought this up and double clicked on this subject. So founders that are listening, as we're wrapping up, cap table, capitalization table, governance. So start formulating and articulating and having these conversations early. I just want to throw out the law of the architect. There is one visionary that typically comes up with an idea, and there may be someone who contributes to building out that idea and building the value of the company, but there is typically one person who is the architect and the visionary, and there may be people who are equal owners or almost equal owners, or 60-40, whatever the case may be. There's going to be someone who's going to be heavy on the ops side, and someone who's got to direct the ship is going to come up with the strategies and leave it to someone else to execute. That's a fundamental law. And I've seen a team right now that's falling apart because someone can't accept that there was a visionary, and right now they're the help. even though they're equal partners. So I will also state about the cap table, you want to have a reserve on your cap table, options to recruit talent. You might be replacing yourself, you might be replacing your co-founder. And when you're putting together, if you are the architect and you're bringing on a co-founder, to have a vesting schedule, have vesting for even both of you, where there's a 1-year cliff, and vesting over 4 years or so is a typical average, where you're really being clear and setting those guardrails to protect your company, your brainchild, if the co-parenting kind of goes awry. So these are really, really salient points that the panelists have brought up today. I also want to just throw out around the mention of, equity stake. This is something that's in flux that, the panelists opened up with earlier today in terms of valuations. It used to be hard and fast, 15, 20%. Now it really goes back to what has been said about the market size. How big are you going to grow for whatever equity stake I have and the amount of money that's in the company. And so understand that market and how big you can grow. With angels, they may be looking at a smaller multiple, maybe a 2-3x, or maybe a certain percentage IRR, internal rate of return. But for VCs that are investing other people's money, they're looking to for you to make up, for a lot of losses in a diversified portfolio where they're not going to be able to raise a subsequent fund if they're not making certain returns. So all of these things come into play. I know that there was a question that came up here. Let's see, there was a lot of questions about, the percentages and the amount. And I think everything that the panelists said comes down to the, identifying your particular company and your model. There was a question that came up, if you don't have early stage funding or friends and family, I want to plug a local company, Open Grants, led by Sadal Trabowski as a source of non-dilutive capital. And, I also want to plug some of the other resources. I know Arlene dropped a line about the toolkit, virtual toolkit series coming up where you can, do a deeper dive. But in our last minute, and we're on the hour right now, thank you, Laura, for dropping that link in there. I just want to throw it back out to the panelists to tell folks how they should approach you and when they should approach you. So go ahead and share, and then we'll pass it back to Jeff to close us out.
I'll start. You can hit me up on LinkedIn or send me an email at monique@growthfactory.us. I'm always happy to hear from people. I am absolutely buried, swamped right now as we're prepping for our launch at the end of September. So please excuse me if I am not immediately responsive. It doesn't mean I'm ignoring you. It just means I'm really behind, but I will get back to you eventually. I really try to respond to everybody that reaches out, and I would love to connect with you and learn more about what you're working on.
Yeah, you can contact me. You can contact me. I'm just my name at gmail.com, lowercase, and or through the Sacramento Angels as well. We're in the middle of a bunch of things right now, but I will respond. If it might take a day or two, but happy to receive your requests or your questions. I appreciate it.
Yeah, feel free to reach out to me on LinkedIn, and if you do, put a little note in there so I know how you got my name, because if it just says connect, and I don't recognize the name, I typically won't. Or email me directly at ken at winningstreetventures.com. That's my firm. Again, we invest in early stage tech startups, and happy to answer any questions you might have.
Well, thank you all so much. It's been an absolute pleasure and honor to moderate this panel and be in the company of these wonderful folks that are helping us to build back our economy and bounce back. I think it should go without saying, but some people just really don't realize how many jobs and livelihoods are created by startups at the earliest stages. And I just appreciate and respect the work that each of you are doing to seed and empower these early stage founders. So with that, I'll pass it back to Jeff.
Hey, Mariah, thank you very much for hosting.
Awesome. Thank you, Mariah. And I co-sign what you just said. And thank you, Mariah, as well as all of our panelists, Ken and Jim. Thank you so much. We really appreciate all the wisdom and experience and expertise that you shared out there. And we want to wrap this up really quick since we've gone long.